Okay, good morning, everybody.
Center.
Oops. Hello. Sorry.
Please do, yeah, no, on the center. Thank you. You can start.
We can start. Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Friday, the 31st of March. It is the last day of the first quarter, the first day in the rest of Donald Trump's life. The oil markets this morning in Asia trading a little bit down, not quite getting over that 70, a little bit above $79, just a pip, but through the momentum of the week, not quite getting to that 80 mark. Will it happen today with the euphoria that we seem to be seeing in all markets? With stocks shaking off the so-called banking woes or banking trauma. I'm stepping away from the word banking crisis. I'm looking for every other word I can choose. Trauma, woes, ills, pains, turbulence. Is that over? The euro trading at 109, WTI well into the 70s, the NASDAQ in a bull market. All indicators pointing at the end of the quarter to somewhat of an optimistic tone. And Mark Ostwald, chief economist and global strategist at ADM Investor Services International, perhaps you could kick us off. Only a week after the German government was having to reassure the world that Deutsche Bank was not going to follow the way of Credit Suisse, we end the quarter and it's champagne. Your thoughts on where we are at this moment now at the end of this first quarter, Mark?
Well, I think people need to be a little bit careful with the movements this week of needs, having seen that huge rally in bond markets in reaction to the banking crisis and the sell-off that we'd had in stocks. It was always inevitable that the quarter-end rebalancing would see markets get rebalanced to stocks. And ironically, actually, on this particular occasion, the whole stock move is being exacerbated by the fact that what we're getting is what I call a bottom 10 into top 10 move, which basically means that a lot of people are going into tech stocks now. With the moves in China on the tech side, yeah, I can definitely see that. Tech stocks look too beaten up in any case, and they've all taken some measures to trim some of the fat that they have. But this whole movement, I think, is still really more a reflection of quarter end. There are reasons for optimism. Certainly the Chinese PMI data that we had today, particularly non-manufacturing PMI at a 12-year high, really underlines that China's recovery from zero COVID is actually getting quite a lot of traction. That non-manufacturing PMI was above all driven by the construction sector, which is a genuine positive. China's property woes aren't gone, but they are certainly abating, and that's significant in terms of their overall demand for commodities. So as far as oil goes, at the moment, we seem to be sort of trying to balance out what we're thinking about Western economies prospects, which in general, if we look at the economic data that we've got coming in, is definitely proving to be better than expected. Not as dire as people are doing. It's not huge, but it's not as dire. I think the tricky part now is what we get in terms of a narrative from particularly the Fed and the ECB on further rate hikes. Markets are assuming the banking crisis puts rate hikes, maybe one more from the ECB, the Fed to hold. I'm not so sure that that's necessarily going to be the case. And the focus today is obviously on Eurozone CPI, which is going to show sticky core CPI. And in the States, the core PCE deflator, which is also going to be sticky. So, I'd be cautious here in over-interpreting this move.
Well, let's welcome Andrew Critchlow, Head of News, EMEA for S&P Global Commodity Insights. Andy, the big focus for OPEC and oil markets has been, I mean, the trauma of the banking crisis, but all the time keeping an eye on China's recovery. Will this be the year of two halves? China's economic recovery seems to be on track with reports today, although the official Purchasing Managers Index has dropped from February from 52.6 to 51.9. So it's not off a cliff, but it is a drop. Whereas the services has taken a significant leap and reaching a 12-year high. Do you think this will be enough to give that wind in the sails of Brent crude to get back to that comfort zone it was in for most of the first quarter, 80 to 85?
Certainly, the flat price at the moment is showing that. Dated Brent closed at about just under $80 a barrel yesterday. It is definitely on a bit of a tear this week. Recovery from fears around the problems with the banks escalating into the wider economy. Our forecast for the rest of the year is for 2.3 million barrels a day of net growth in the market. That's largely fueled on the basis of a strong recovery continuing in China. We're seeing a lot of jet demand coming back into the market. We're starting to get into summer season as well for a lot of products now. So the emphasis turns away from diesel towards gasoline. That's going to suck up a lot of aromatics into the blending pool. That's going to help petrochemicals, which has been definitely under pressure. Recently, we just held our World Petrochemicals Congress in the US. I think it's the largest convention for petrochemicals globally. The mood there was pretty glum, actually, for the rest of 2023. Producers, and interestingly, producers in the US and the Middle East, which benefit from obviously more competitive streams of ethane feedstock, were pretty glum over demand, and of course China is a big part of that story, but the wider global economy as well. So I don't think we're out of the woods. It's going to be stormy, but
no pun intended.
No pun intended. But I think that like all storms, they come to an end, and ultimately, we're still on a recovery story from COVID. So you're going to have important streams of demand coming back into the market increasingly this year, such as a continued recovery in jet fuel.
Let's go all the way over to Mexico with Dr. Aldo Flores Quiroga, former Deputy Secretary of Energy for Hydrocarbons at Mexico's Ministry of Energy, and also now a senior advisor at FTI Consulting. Aldo, there's many places that we haven't had a chance to check in with you in a while. Let's start today because there's a number of geopolitical headlines. I don't know, they're certainly not connected, but nonetheless, I'd welcome your view as to where Latin America is a few months into the new government. We've got Bolsonaro just landing back in Brazil after a few months in exile in Florida. We have obviously the news overnight of Trump's charge, arrest, whatever we want to call it, and we have the news earlier in the week of Honduras turning towards China in a deeper way and kicking out any relationship with Taiwan. So I don't know if all of these things are connected, but just a check-in as to where the Americas are, please, Dr. Aldo.
On the political side, the Americas have moved leftwards, as we have discussed before. And but it's a very varied set of leftist regimes. It's very different shades of pink, let's say. And it would be very difficult to just say that there's a definite direction for all of these governments. They're doing different things. To connect with the energy story, most of them are emphasizing still hydrocarbons. Colombia is the one that is trying to forge a different path, but it will face, and as everybody is already facing, the difficulties of an energy transition that is proving much more complex than people initially thought. The other aspect of this is that given the leftward turn of the region, there's more policy uncertainty. And that is being reflected in the enthusiasm for investing in the Americas. So it has really become, in terms of oil production, a story that boils down to Brazil and Guyana, with the rest of the countries either stagnant or with a falling output. And at least for the short, medium term, this is not a picture that will change much.
What about the sort of general macro health? Has there been impacts from this tightening cycle in the U.S. of the Fed on rates, the banking trauma of the last few weeks? Has there been any tremors of that felt in South America, in Latin America?
Not as much. Capital requirements have been more stringent for banks. The interconnections are less less tight with respect, at least, to what the bank balance sheets and what we could expect there. But of course, the round of tightening is affecting everyone, and there's much policy emulation in the region with respect to the increasing rates that the U.S. has been showing. So the way will eventually appear in the economic picture of the region is if the U.S. economy goes through a harder landing than expected, it will definitely have an impact on the region, not only in its oil exports, but overall economic output.
Mark, just picking up on the earlier comment vis-a-vis China, we all were, or you weren't actually, you were in Turkey, but the very dominant theme at IE Week and at CIRA Week, the big sort of energy events of the first quarter globally, it's a year of two halves. China will, this as Andy mentioned there, S&P Global have that 2 point whatever million barrel a day recovery of demand, or a growth in demand in 2023. And of course, to get to 2 million or over 2 million, as it's reported by the IEA, you're going to have a bumper second half of the year, because we're not seeing anything like that in the first quarter, at least, and certainly not in the first half. What's your read on this year of two halves narrative that was being sold everywhere in the first quarter vis-a-vis oil demand growth?
I think it's probably not going to be a year of two halves. I think it's going to be a year of a great deal of uncertainty, to be very honest. I think it's too orderly. And given the disruptions that we've seen over the last 3 years, I'm surprised that people, want to sort of carve this out in such an orderly fashion. We've got the world basically still trying to re-globalize, i.e. find its new supply chains, redistribute, whether it's energy or anything else. My suspicion is that what we're getting, the most important impetus for the oil market is probably going to be more disruption to supply. As there's more and more evidence of disruption to supply coming out. Russia's got, potentially going to have to cut some of its output. You've got the problems in Iraq. And I think that's really where the support's going to come from. And also, it's quite clear that in a number of OPEC countries, they are struggling to actually increase output to the levels that they've got as quotas. And those are all broadly supportive factors. And I think in certain sense, more important than this idea of a year of two halves, which I find I don't know. I think that whole idea is a little bit moot, because there's so many uncertainties out there. And to sort of pre-plan how the year's going to go, I think is probably not very wise.
Andy, just speaking to some of the elements that could be moving the oil markets away from the big trends. I mean, the Fed rates, the tightening cycle, the war, but then we have sort of the old-fashioned inventories are low, SPR very low in the US, and now we have disruptions in the Europe with national strikes, refineries shut in France and so forth. Just speaking on the Europe infrastructure, these national strikes in the UK as well, where you are, Germany, is this a growing area of possible market disruption that could impact price direction in the second quarter, or is it a bit minor?
No, I think it's a significant moment, but it is more in terms of its price implications. It's more relevant to what's happening with products in Europe, and we're definitely seeing some displacement of flows as a consequence of that. You know, the entire French refinery sector has now been out for over a week. That's having a big impact on both storage and physical flows of primarily diesel into the French retail transport fuels market. And, you know, you've got to remember France, Europe's second largest economy, but also Europe's largest producer of diesel. So, and given the political situation in France, you know, you've got to anticipate that we're going to see more of this kind of disruption throughout the summer in that country. So these displaced flows where you're getting, you know, perhaps, you know, refined product coming from Africa now into Europe to make up for those displaced volumes out of France. You're going to see more examples of that. But I think that what's important here, you mentioned our forecast, 2.3 million barrels a day of growth this year. 70% of that is contingent on Asia. So Asia's still the overriding driver behind this, I wouldn't call it a bullish market story for the rest of the year, but this recovery story for the rest of the year. And it's that 70% of demand growth that's going to come from Asia, which is going to support Brent prices to trade in that range of $80 to $85 a barrel. The really interesting thing is that at those price levels, we haven't seen a kick in US production ramp up. You know, US oil production is definitely increasing gradually, slowly. If you look at the rig counts, though, it's very marginal every week. What we're seeing, previous cycles, you've seen, you know, US rig counts increase, you know, fairly dramatically once you get above that $55 a barrel price range. I know that other people have talked about that as being the cost of the marginal barrel in the US. I think that's moved now because you haven't seen it. A big factor in that is cost of capital and the rising cost of debt in the US. A lot of the smaller drillers in the US, of course, highly leveraged. Access to capital from the banks is becoming a lot tighter. So coming back to Mark's point at the start, I think a lot of focus here, it comes back to central banks, it comes back to the Fed and where the Fed goes from here. And if this banking crisis has spooked them enough to pull back on further rate rises this year, or whether they are going to keep going, focusing on pegging back inflation. That obviously trickles into the ECB and other major central banks around the world. And you know, it's really a battle between the central bankers and the OPEC policymakers at the moment. Of course, we've got OPEC, the Joint Ministerial Monitoring Committee meeting on 4th of April, beginning of next week. You know, I think looking at fundamentals at the moment, the call on OPEC crude, which is expected to go higher throughout this year. Mark referenced that a lot of the OPEC producers, the smaller producers, certainly in Africa, are struggling actually to meet their quotas. The only real spare capacity is coming out of the core Gulf producers. And of course, behind all of this, you've got problems with Iraq and Kurdistan now, which has taken out 400,000 barrels a day. All of a sudden, there isn't a lot of spare capacity. But do I see OPEC moving next week on the basis of what the JMMC discusses or decides? No, I don't. Not really at the moment.
Aldo, I wanted to talk to you a little bit about what's happening between the US and Mexico. Obviously, you're former Undersecretary of Energy of Mexico at a time in which there was a real sort of renaissance in the opening up and reform of the Mexican energy system, liberalization and inviting international actors to come and partner with you. That has been reversed by this the next administration that came in after you. And now it seems they're in a big fight with the US and possibly the US threatening some kind of a trade war. If you could give us an update on that, what does it look like to you? Where do you think it's going?
Sure. Let me just begin because I wanted to echo something that Mark mentioned.
Please.
And yeah, I think it's the environment is too uncertain right now, and making any definite conclusions about where things are going is going to be just unwarranted. Right now, the best approach is just to be careful and using common sense in managing risks. So, but this connects with the U.S.-Mexico relationship. Let's say that most of the friction boils down to energy investments, and migration. As you know, Mexico is a transit country for thousands and thousands of migrants coming from Central and South America. And they also come from other parts of the world, but that's mainly a key point of friction. And it somehow seems to also be adding noise to the type of negotiations in other sectors in U.S.-Mexico relationships. So what we are waiting for is to see what's going to be the final U.S. decision regarding this dispute with respect to investment rules that apply to foreign companies in Mexico. Many U.S. companies made investments both in the electricity and the fuels markets. And these investments have faced a number of obstacles. And the U.S. is mostly complaining on competition grounds, not in terms of ownership. And there's all these sorts of things that are very clear in Mexican law, and that especially with respect to ownership of oil resources. But this is about basic fair treatment under international trade practices, but especially obviously under the US, Mexico, Canada trade agreement. So this is something to be paying attention to. We'll learn in the next few months, maybe next month, what will the US decision be. But on the other sectors, it's a different story. The mountains that you see in the background extend east, and maybe 30 minutes from there or less, you will find the site where Tesla is going to build its largest factory ever. And this is very telling of a very tight integration in the North American automobile industry. But this extends to electronics, electrical equipment, and many other industries. So this is mostly about energy, and it will affect eventually the rate at which Mexico can produce.
And it
energy.
also seems to be connected to your first point, which is Mexico is a leftist government with a very different idea and outlook, even though you would say Biden is left of center in American United States language. It's not quite left in the context of Latin America definition of left. And so it's a very different political economic outlook from the government in Mexico.
Well, let's say that it's leftist with respect to energy, but it would be hard to say the same thing with respect to everything else. Okay. It's fiscally conservative. There's an autonomous central bank. There's support for free trade. So it's a very strange breed of leftist ideology with fiscal conservatism.
Interesting. Let's go to the survey question, and I want to give our three speakers a chance to give us their crystal ball outlook for the second quarter. But before then, U.S. equity futures ticked higher today and through the quarter, and Asian stocks advanced as a gauge of global shares headed for a second straight quarterly gain. Will this lead to higher oil prices in Q2? We've seen $81 on average on Brent in Q1. Will we see higher oil prices in Q2 with this sort of wind in the sails of optimism that we end Q1 with? Yes, no, or more or less the same? Mark, you kick us off with your sort of crystal ball for Q2. Again, Q1 had a lot of noise, but ultimately it kind of feels like it ended where it started, with a sense of optimism that the year ahead would be a better year. Your thoughts of how Q2 will or will not be different than Q1?
Well, I don't think it's going to be different in terms of the volatility that's sort of embedded in markets. A lot of that volatility is down to higher rates, lower availability of credit, and the high cost of credit. And I think Q2 may actually be one where we start to focus in more on rising defaults in the corporate sector. But nevertheless, still be impressed by the fact that whether we're talking about North America or Europe, UK, and ultimately we should see a pickup in Asia as well, the fact that consumers keep on spending, and that's actually probably been the most important story of Q1, which everyone thought was not going to be the case. And consumers do keep on spending. I think there's obviously still a lot of boost coming from the travel sector, a lot of pent-up demand from COVID, and that's not run its course. But for Q2, I think we will probably see the banking woes resurface, because ultimately what this is about is we've got not very sensible accounting rules. No one's done anything illegal. One should stress that, but we should really introduce rules which are more mark to market. And I see the regulatory drive starting to pick up. Everyone's starting to talk about, oh, we didn't really address most of the problems after the global financial crisis. Of course not, because they thought it was all about bank capital, when it's actually about accounting practices and market instrumentation. And that will take time to resolve itself, but markets will be wary of that. It's not necessarily that the regulation will come through, but the fact that if they start to see more and more moves by the Fed, the ECB, the Basel Group to restrict, moves to basically change the way that markets operate, liquidity will dry up. And I think that's basically where the real problem lies, that the overall pool of liquidity is going to start, is being gradually reduced. And that is going to present more and more challenges as we go forward. And also that companies are still struggling in a lot of cases to deal with the higher energy costs that we've got, the higher base costs. We may have come off the peaks with energy prices, but we've got a much higher base level, and that is proving a big challenge for the corporate sector.
Yeah. Andy, your thoughts for Q2, change on Q1, and particularly welcome your insights, if you have any, where you think the war in Ukraine may go in the second quarter. Andy.
So our price forecast into second quarter, middle of the year, is for crude to gradually tick up between $82, $85 a barrel, and going into the second half of the year, where towards the back end of that period you could see crude testing $90 a barrel, and lots of the fundamentals that we talked about here will play into that. I think that Mark's point with regards consumer spending and the strength of consumer spending globally is telling, because that's really the pressure that is putting central bankers in an awkward position at the moment. Politically, it's getting very difficult for them to continue to tighten monetary policy, continue to increase rates. That's having lots of knock-on effects. You could argue that this increase in rates is what has triggered some of the volatility in banks and financials over the last month. But inflation is their number one priority, and containing inflation in the US and Europe is going to continue to be a major priority, and that is going to really influence where prices go over the next 3 to 6 months. Coming back to Ukraine and Russia, I had a meeting with some security sources this week. There was a very big meeting in London of European security sources that was held here, and the impression that I got was very different to some of the music that is made public. That Russia is in a bad position strategically on the front in Ukraine, that the war, they're going to find it hard to sustain. Certainly from the security community in Europe, the people that I was speaking to about that subject this week, they are digging in for the long haul. They do not see this conflict ending anytime soon, and in some instances they see it taking on a different dynamic. There is also a great deal of concern within the security community of the targeting by nefarious actors of infrastructure, primarily across Europe, whether that is energy or other key critical infrastructure that may be tied into the conflict. So, this comes back to Mark's point that, and Dr. Aldo, that there is a great deal of uncertainty already in the markets that is linked to the macroeconomics, and then you bring the geopolitics in, which of course you can't avoid talking about Russia and the war in Ukraine. But certainly from the experts who are looking at this on the ground, the security experts, they see this going a lot longer.
Yeah, well, I think if you look at the previous, the previous expeditions of Putin, whether it be Chechnya or Georgia or other areas, they've always been years and grinded over many years rather than devastatingly overwhelming force. Dr. Aldo, last word with you, the outlook for Q2 from your beautiful perch there in Mexico.
I have very little to add. I also see it as ongoing uncertainty. That last year was one of the most difficult years for this type of exercise, right? The signals were going in every direction. And I don't think this has changed. In fact, we have more uncertainty given the banking crisis, whatever is going to happen with the decisions of the Fed and the next decisions of the European Central Bank, the war in Ukraine. So there's many undefined factors still, and so it's very hard to pinpoint a specific direction for the market.
Okay, well, I think as we said in the survey, and this seemed to be tending towards more or less the same. I think $80 on Brent would be welcomed by everyone. My sense of the second quarter, is it'll probably deliver another black swan, not a devastating one like the war last year, but a bit like the banking trauma in Q1. What will be the black swan of Q2? I think it could be something much more substantial, perhaps, but this, where I started this morning with the half joke on Trump, I don't think is a joke, because ultimately his arrest and in the vortex of that sort of face-off between the red and the blue in the United States, you've got really explosive potential cocktail there coming together at a time when red and blue has to agree on a debt limit ceiling lifting in the Congress. So that is not a minor moment. If all of those toxicity gets swallowed into the same bucket, it could be really problematic in the second quarter. That's just that little piece. There's never mind many others, but that's one that gets my attention a little bit this morning on the news of Trump returning to the center stage, and with him and his nature swallowing everything into the one bucket. And that's not a very positive place to be. Andy Critchlow, as always, really appreciate your getting up bright and early, you and Mark in London, but not as early as before. You got the clock last week. It gave you an hour. Probably still feels like the middle of the night, but nonetheless. And Aldo, of course, I'm not a time in Mexico City. What is it? It's certainly not blue skies.
I read everyone.
It's certainly not blue skies and sunshine. That's for sure. The beauty of the backdrop. But thank you all, everybody. Have a great day. We'll catch up with you next week with Brent trading this morning. Little change at $79 a barrel. Thank you.
Thanks very much, Sean. Thank you.